I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-alize test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our idea, our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. As usual, we have another exciting show this month, and we titled it End-of-Year Checklist of things to do financially, but really when you think about it, these are things that you can pick a time of year and look to do them the same time every year.
Yeah, well, hello, Steve. Welcome to the show. It's good to be here. This is our first show of the year, and this is an appropriate time to do this because, I mean, you're right. You can do it any time, but the important message that we want to get out to everybody today is that the process of going through an end-of-year checklist is important because there's things that you need to pay attention to. And oftentimes it's a pitfall that people just get, hung up in their life and just miss these things. So we're going to kind of review all these important highlights that we have to address.
And if I could start by saying, our clients have a financial plan that they follow. They have an income model which we review annually. If someone doesn't have a financial plan, they should look to get one with somebody. But once you have a written financial plan, it's good to review it every year.
Yeah, it's like putting together a playbook, which is the financial plan, and then you have to continually update. It's not something you just stick in a drawer and forget about it. It's because things change. A lot of things change. The market changes. Your risk tolerance changes. Your family situation changes. A lot of changes.
Yeah, and it's always good to review and track annually. Where are you? If you have a goal that's 10 years away, take a look at it and see how you're doing.
Yeah, that's important, Steve. I think the more you do that, I always feel like if there's something that you can measure, that it's something that you can improve.
Yes. Yep. The other thing, and next thing we'll go on to is employee benefits. And I know should be reviewed on an annual basis.
Yeah, so employee benefits, and that covers a pretty wide spectrum. I mean, it goes anywhere from, your health insurance to your 401k contributions. Some of these employee benefits have gotten pretty sophisticated over the years. You can put money into a health savings account. There's really a lot you can do, but yeah, they need to be reviewed. Regular. Yes.
And also with that, when you look at the 401k in a plan, the amounts.
Yeah.
Change.
So the amounts change, like the maximums.
Yes.
In fact, right now, I believe the maximum went up to 20. I think it's 22,000, 23,000.
It was 22,523
in 23.
Yep.
And then if you're over the age of 50, there's what they call a catch-up provision, and that was 7,500.
Yes, yep.
I believe those numbers are
They stay.
going up in
Yeah, yeah.
24.
Yep.
Yeah. But anyway, so let's just say, you know, it's roughly $30,000 if you're over 50, and if you're under 50, it's 22,500. It's the maximum that you can put into the 401k plan and still be, now so this gets a little tricky.
Yep.
Because if you're putting it into a traditional 401k, if you exceed that amount, then it counts as it's a non-deductible portion of your 401k. So then, you know, down the road you can eventually move that into a Roth IRA.
Yes. And I don't know how much we want to get into health and life, but another one we should cover is HSAs for a benefit from your employer.
Yeah, so the health savings account, HSA, is an account that you can use on it. You can get a tax break. So you can put into up to $7,500 a year into these accounts, and you can use that for medical expenses. Either it's co-pays, deductibles, or even things that your traditional health insurance doesn't cover. So if you're doing like things that are of a non-traditional manner,
Yep.
right? I should not, maybe non-traditional is not a good word, but if you're doing things that your insurance just doesn't
Yep.
cover, right? Could be anything, but it's still health related.
Yes.
I don't know, like an example would be you want to see a nutritionist.
Yeah.
That would be an example. You want to see a nutritionist, and your health insurance doesn't cover it, but you can use your HSA dollars to pay for it. So in essence, what you're doing is you're using pre-tax
Yep.
dollars to pay for that expense. So it gives you a little bit of a tax break.
And what about co-pays for prescriptions?
Yeah, so you would use that. That would be an ideal use. So it was originally designed for these high deductible plans, right? So if you have, let's say that you have a health insurance plan with a high deductible. So the high deductible is going to be a lot cheaper than if you get a very low deductible, because basically what's happening is you're self-insuring, or you're going out of pocket for a much larger amount. So they're shifting some of the cost, or some of the risk, if you will, to the employee. Mm-hmm. Well, in that case, you can use HSA dollars to pay for that amount till you hit your deductible. So that's what a lot of people do.
Yep.
So that's a good use of the HSA account.
And then accumulating it,
Yeah. Yeah, the answer is yes.
going into retirement.
You can accumulate your dollars, roll them over. Not roll them over, but in essence, what you're doing, if you don't spend it all this year, you can spend it next year somewhere down the road, or like you said, into retirement. You could just carry those dollars over and spend them as you see fit.
And I've seen clients accumulate quite a bit of money in there, and then
Yeah,
retire.
and they
It kind of
usually,
sets a gap in
depending
between.
on the plan,
Yeah.
they make it really easy too. Like
Yeah.
they'll give you like a debit card. So you go to maybe you go to a drugstore, and you're buying something over the counter, and it counts, right?
Yep.
But so you just pay with your with your debit card, and it makes it very easy.
Oh, yes, that's good. Now let's talk about a little bit about tax planning, which is everybody wants to keep as much money as they can in their own pockets.
And this is a very important and appropriate time of year to do that, because a lot of people are in the process of getting their taxes done. So the tax planning is important to do on the front end, right? So there's no surprises.
Yeah, and there's things such as the IRAs and things people can do on an annual basis for last year's taxes.
So an IRA contribution you can make up until the tax deadline, so April 15th. So if you want to make a contribution for an IRA, it's one of the few things that where you can sort of backdate the contribution, if you will. So you have up until April 15th of this year to make a contribution for last year. So a lot of people do that if they've got, let's say, they have some extra cash and they want to reduce their tax liability. It's a good way to do it, because if you put money in the traditional IRA, then you get a tax break. Or, you can put it into a Roth IRA and you don't get the tax break, but you get all the benefits of the Roth.
And I know more towards the year end, some people look at tax harvesting, looking at what they have losses in.
Tax harvesting.
Or lost harvesting, yes.
Yeah, so the tax harvesting would be where if you have a lot, let's say you have a lot of capital gains and you want to offset them with capital losses. So you can do that. So let's say you sold a bunch of stock and you've got large, capital gains. Let's say you have a stock that just has highly appreciated and you have large capital gains in there. You can sell stock that has losses in it, and that'll offset the gains, right? So you could just, because otherwise, if you only have losses, you can only claim up to $3,000 a year in losses, capital losses, and the rest you just have to keep carrying over into the next tax year. But if you have gains, you can match the losses to offset them.
And then if you like one of the holdings and you want to take the loss and you want to get back in, there's the 30-day rule.
Yeah, so I believe they call that a wash sale, right?
Yep.
Yeah, so so you can't harvest the stock tax gain or loss and then jump back. You can't sell it one day and then buy it back the next day. You have to wait. You have to wait 30 days to go back in, and that rule makes a lot of sense, because otherwise you'd have people that are basically just trying to skirt the system and just make a transaction solely for tax purposes.
And the next one would be assessing your investments, and I would probably equate this to someone's risk.
Yeah, so when you look at your investments, and a lot of times, people tend not to do this, but it's really, really important, especially like if the stock market is going up, people tend to forget what their risk is. But then when the market starts to go down, then all of a sudden it's like, oh, yeah, that wasn't my intention. I thought my risk was different than what it actually is. And, we ran into some of that back in 2022, which, boy, seems like a long time ago, but it was only last year. But in 2022, we had a trying year of the stock market going down and then the bond market going down at the same time, because interest rates kept creeping up and up because the Fed was increasing interest rates. They increased interest rates like 9 times over the course of a year, so it was a lot. So this really put investors in a position where they really had to take a look at what their risk was. So it is important to look at that and assess your own risk tolerance frequently, but at the same time, Steve, I will say that the people that tend to win in the stock market are those that have the long view, the long-term approach, the people that can just kind of like wait out these volatile times in the market. And using 22, this is a perfect example, because in 2022 the market went down. And it wasn't just due to interest rates. It was due to a lot of things. A lot of the things that we're seeing over in Europe all the trouble, all the strife. But our markets are resilient, and they always have been, and that was really proven last year when the market just bounced back. So what you don't want to do is overreact. And I think that's where the value of working with an advisor comes in, because it's just really the job of the financial professional to communicate the importance of staying the course and riding out all these volatile times. Because really, when you think about it, Steve, you know, the stock market is volatile, and it's been volatile for a long time. I mean, it's been volatile forever. But in more recent times, it's been even more extreme. You know, we've had, you know, 3 or 4 different crises just, you know, since the turn of the century. So it's important to, you know, to stay the course.
And the last one for investments, and I would consult your tax advisor on this one, but a backdoor Roth conversion.
Yeah, so backdoor Roth conversion is when you're taking money that you wouldn't otherwise be able to contribute to a Roth because of your income. So there's an income restriction. So you can do what they call a backdoor Roth by converting dollars that you put into a traditional IRA. So I guess the traditional IRA is the front door, and the Roth IRA is the back door. So you know, so you're taking a circuitous route to get there, but you're converting dollars that you originally put into a traditional IRA. So the way that works is you can get from a traditional IRA to a Roth IRA simply by doing a Roth conversion. And when you do the conversion, you're paying a tax. So you pay the tax in the year that you do the conversion, and then you have a Roth, and then the Roth grows tax-free. So that's really a way for people to do Roth accounts that really don't qualify otherwise. You know, here's another one, Steve, that doesn't get talked about enough, but I alluded to it a little bit earlier, and that is, if you have a 401k and you're of a certain age where you can take money out of your 401k account through an in-service distribution or an in-service rollover, if you take that money and you can convert that to a Roth at that point in time too. So that's also like you're achieving the same thing by doing, you know, the back door. The other thing that I said earlier was that if you put in more than your allowable deductible amount, so that last year it was $30,000. So let's say that you put in 40, but you were only allowed to deduct 30.
Yep.
That extra $10,000, you can, when you do this in-service distribution, you can just roll it over into a Roth IRA, and then you have tax-free growth over your lifetime. So the Roth is really, I feel, an important part of planning at any age, but in particular for younger people. It's a way to get tax-free growth, because the younger you are, the longer you're going to have tax-free growth. So really, the Roth is really the way to go. So these are all things that we talk about with our clients all the time. So if you want, and actually we'll give anybody that is watching today a second opinion. So if you want, you know, some more information, we'll put our information up on a screen, and you can just contact us, and we'll sit down and we'll go over some of the strategies that we use for our IRAs and our Roth IRAs.
Well, the next one would be charitable giving. And there's a couple different angles here.
Yeah, so with charitable giving, you know, of course, let's just start out with the basics. So let's say you have charitable intent and you give money to your charity regularly, so whether it's your church or your the college that you went to, or whatever it is. The way you get a tax break on that is you have to fill out Schedule B. And the hurdle that you have to get over with Schedule B is you can only deduct that amount over a certain dollar amount. I think it's a percentage of your income. And when you do that, it's like sometimes it's hard for people to get a break on that. But one way around that is if you're taking required minimum distributions, which you have to do if you hit the age of 73. If you're taking a required minimum distribution, the IRS will allow you to direct that money to a charity. So it has to go directly to the charity. But if you do that, then you don't pay taxes on that money. So an example would be, let's say that you feel strongly and you want to donate money to your alma mater. Okay, so you would make a donation to your alma mater anyway, but if you do it through the operation of your IRA, now that distribution. So let's say your RMD is $15,000, and you want to send $10,000 of it to your college alma mater. You tell the financial institution to write a check to the college. The college receives the money, and then you don't report that $10,000 on your tax return as taxable income. So you're really, in effect, getting a tax write-off, dollar for dollar, for that $10,000 contribution. So that's really, I always tell our clients, if you have any kind of charitable intent, make that contribution through your IRA account.
What about donor-advised funds?
Yeah, donor-advised funds are really an effective way to manage your contributions to charity and then also get a tax deduction at the same time. So you can put a large chunk of money in a donor-advised fund. So let's say last year, at the end of the year, you wanted to put $20,000 into a donor-advised fund, but you didn't have $20,000 to necessarily give, right? So you could put the $20,000 in the fund, and then the fund is invested. So it's invested in. It can be invested in stocks or stock funds or bonds or cash or whatever. That's really up to you. And then from that point on, you make contributions. So you could make monthly contributions to your church. You can make annual contributions to your college. You can, donate to the United Way. There's a bunch of ways you can make contributions through these donor-advised funds, but it makes it a lot easier to manage because you can even write like smaller amounts that go directly to the charity. So it's really something that more and more people are taking advantage of, because it used to be, only the ultra wealthy were doing these foundations, because that's really what it is. It's kind of like a foundation, right? It's just, you're just making all these grants from the foundation. And these donor advised funds always vet out these charities, so they make sure it's a legitimate 501c3 charity. So you're not just making anybody a charity. It's a legitimate charity in the eyes of the IRS.
And if we talk about non-IRA dollars, and someone has highly appreciated stock versus something that doesn't have much gain.
Yeah, so if you want to donate stock, let's say you have highly appreciated stock. Let's say you bought Apple a long time ago, and it's now worth a lot of money, and you didn't pay very much for it. And you just put in your will that you want to donate that stock or maybe not even in your will. You can even do it while you're still alive. So if you're, let's say, if you wanted to sell the stock outright, you'd pay capital gains tax on all that appreciation in the value of the stock. Well, if you donate it to a charity and let them sell the stock, guess what? All the tax liability gets wiped out, right? So it just makes a lot of sense in that example that if again, it all comes down to charitable intent. Honestly, Steve, some people have charitable intent and some people don't, right? So if you do have charitable intent, then, talk to us, because we can find out ways to get money to your charity and get it to them on a tax favorable basis. Here's another idea. You can name your charity as a beneficiary of your IRA, right? So let's say you name your college, your dear alma mater is going to be a beneficiary of your IRA account. Well, if that IRA goes to, let's say you have a choice of giving the money to your kids or giving it to your alma mater. If it goes to your kids, they're going to pay taxes on it. They're going to have to do it under the new rules, which, they're going to have to take it out over 10 years and all that. If you give it to your college, guess what? They get it. They don't pay taxes on it. So it's really, an efficient way to, and colleges love this, by the way. They love it. So, that's something to think about too. Here's another idea, life insurance. If you want to buy some life insurance, and you can actually have the charity own the policy, right? And then you give them the money to pay the premium. And that's treated as a charitable deduction, right? So you can either, you can give them part of your RMD, or you just give them a contribution, and they use that to pay the life insurance premium. And then guess what? When you die, they get a tax-free death benefit. And we just settled on a case, a pretty sizable case last year, where we had a client buy $1 million life insurance policy, and she was pretty insistent on it being $1 million. So she wrote a check to the college every year for them to pay the premium, and she just passed away last year. And guess what? The college filed a death claim, and they got $1 million. So it was good. It was a good deal.
And that kind of goes into our last one, which is checking up on your estate plan.
Yeah, so all these things that I just talked about are part of your estate planning, right? So you want to think about. It's never too early to think about how how you want your legacy to look. Do you want to go to your spouse, your children, charities, etc. So this is a good show, Steve. I mean, these are all important things, and I hopefully our viewers got something out of it. But we go on the road and do workshops, and in addition to doing this right here in the studio here in our office in Pottstown. But we have some upcoming events in our Retirement Design Lab. I'll put that information up on the screen. And then if you need more information from us, you can either contact us by phone or by email. So with all that being said, this is the end of another show here on the PCTV network, and we'll be signing off, and see you next time.